America's retirement landscape is undergoing a seismic shift, one that's dividing investors, sparking debate, and leaving some people wondering, are we charging fearlessly into a new era, or is this the calm before a financial storm? The cult-like faith in the stock market has never been stronger among U.S. savers, and the numbers spell out just how far this trend has traveled. Let's take a closer look. Pension funds, along with individual households, now own a record-breaking proportion of stocks relative to all their other assets. According to recent data, defined contribution (DC) pension plans, which put the investment responsibility firmly on the employee's shoulders, are approaching a whopping 70% allocation to equities. For everyday Americans, stocks now account for over 45% of their total financial holdings, an all-time high. But here's where things get controversial. Has the decades-long march toward stock ownership hit its natural ceiling, or are we witnessing a fundamental change in how investors think about risk and opportunity? It's a hot topic because, while supporters see greater potential returns, skeptics worry about what risks might be buried beneath the surface. John Higgins, chief markets economist at Capital Economics, points out that pension plans' exposure to stocks hasn't been this high in at least 3/4 of a century. The reason? The steady abandonment of defined benefit (DB) pension plans, where companies bear the brunt of investment risk, in favor of DC plans, which shift much of that risk onto workers themselves. In practical terms, DB plans traditionally leaned heavily on bonds to meet their promise of steady long-term payouts to retirees. On the other hand, DC participants who don't have those fixed liabilities have flocked toward stocks in hopes of bigger gains, even if it means taking on more volatility. For context, back in the 1950s, DB plans dominated. Over 90% of U.S. pensions fell into this category. Fast forward to just 20 years ago, and the field was still evenly split. Today, roughly 80% of pensions are DC plans. In other words, we've entered unfamiliar territory and, potentially, a more perilous one. With workers' retirement security tangled up in the fate of the stock market and U.S. equities starting to look expensive by many traditional measures, the stakes have never been higher. And this is the part most people miss. Loading up on stocks usually works out for long-term investors, largely because equities have historically outperformed bonds. Keith Lerner of Truist Advisory Services highlights this growing divide. As of August, the S&P 500's one-year performance soared to nearly 16%, more than quadrupling the 3% return from major bond indices. Over 3- and 5-year stretches, the stock market's edge ranks near the very top of historical comparisons, sitting in the 93rd and 95th percentiles, respectively, for outperformance. But can stocks keep trouncing bonds? That question splits opinion right down the middle. Pessimists note that the 4-decade bull market in bonds appears to be fading away. With inflation lingering, the national deficit ballooning, and a possible decline in demand for long-term bonds, the old notion of bonds as risk-free assets is being challenged. That shift could tip even more savers into stocks, fueling a cycle that has both promise and peril. Optimists say that, if stocks continue their winning streak, tomorrow's retirees could be in for a windfall. But here's the rub. If equity markets tumble unexpectedly, those on the verge of retirement could see their nest egg shrink faster than they ever imagined. Traditionally, as retirement neared, people shifted more money into bonds for safety. Yet now, given the reevaluation of bond risk and the allure of stock returns, some wonder if this once common practice may be fading away. And let's be honest, even as equity valuations reach nosebleed territory by historical standards, many people aren't showing any sign of slowing down their stock purchases. In fact, Deutsche Bank analysts just raised their target for the S&P 500, banking on further gains fueled in part by excitement around artificial intelligence and technology innovation. John Higgins of Capital Economics puts it bluntly, high allocations to stocks don't guarantee an imminent correction. He expects the market will move higher in the near term, but he also cautions that these extreme positions could be a warning sign. So the debate rages on. As long as stocks keep outpacing bonds, many future retirees will stay the course, pouring their savings into equities despite the looming risks. But what do you think? Are we heading for a rude awakening as this stock market enthusiasm intensifies? Or are today's investors simply adapting smartly to new realities? Should retirement savers rethink their faith in equities, or is their optimism justified? This topic isn't just about numbers, it's about our financial future. We want to hear your take. Do you agree with the bullish sentiment, or do you see trouble on the horizon? Maybe you have another take entirely. Let us know in the comments below. Let the debate begin. Important note, the opinions expressed here are those of the author and may not reflect the views of Reuters News, which follows the Thomson Reuters Trust principles of integrity, independence, and impartiality. Jamie McGeever is a seasoned financial journalist with global experience, reporting from cities such as Brazil, Spain, New York, and London, and has expertise in markets, economics, and policy.